Welcome to this explanation of how Loan Plus 3 loan management software helps lenders make decisions on your loan application from the borrower's point of view. This video will guide you through the credit evaluation and loan decisioning process. Keep in mind that each lending company has its own specific policies and criteria for determining credit worthiness, so the exact reasons for approval or denial can vary. However, the following points highlight key factors that typically influence these decisions. When you apply for a loan, lenders using LP3 software will evaluate your credit risk based on various committal reasons. These reasons are crucial in deciding whether your application is approved or denied. The software even has an ECOA, Equal Credit Opportunity Act, section where lenders record these specific reasons for denial. Understanding these reasons can help ensure fair and consistent lending practices. Here are some common reasons why your credit application might be denied. Excessive obligation related to income. This means you have too much existing debt compared to your income, which could make it difficult for you to repay another loan. Unable to verify income. If the lender cannot confirm your income, perhaps due to missing or unverified documents, it can impact their confidence in your ability to repay. Length of residence. Not having lived at your current address for a sufficient period might raise concerns about your stability. Temporary residence. If your current living situation is not permanent, it may suggest financial instability. Unable to verify residence. If your residence details cannot be confirmed, it can lead to questions about the accuracy of your application and your stability. No credit file. If you don't have any credit history, it makes it challenging for lenders to assess your credit worthiness. Insufficient credit file. A limited credit history doesn't provide enough information for lenders to evaluate your reliability. Delinquent credit. A history of late payments or defaults indicates a potential risk in repaying future debts. Poor credit performance with us. If you've previously had trouble repaying loans from the same lender, they may be hesitant to approve a new one. Delinquent past or present credit obligations with others. A record of late or missed payments with other lenders suggests a possible risk of future delinquency. Credit application incomplete. If your application is missing essential information, it cannot be fully processed. Garnishment, attachment, foreclosure, repossession, collection action, or judgment. These serious legal or financial actions indicate potential financial distress. Bankruptcy. A past bankruptcy suggests previous financial instability that could affect your ability to repay a loan. Value or type of collateral not sufficient. If you're offering collateral, but its value is too low or it's not suitable for the loan, your application might be denied. Credit not guaranteed under requested terms and/or conditions to anyone. If the specific terms you're requesting don't meet the lender's general requirements, approval is unlikely. Other. Lenders can also have company-specific reasons for denial that are not listed. Inadequate cash, down payment, or trade-in. For certain loans, not providing enough upfront payment or trade-in value can lead to denial. Insufficient number of credit references provided. Not listing enough references to help establish your creditworthiness can be a reason for denial. Unacceptable type of credit references provided. If the references you provide don't meet the lender's standards, they might not be considered valid. Unable to verify credit references. If the lender cannot confirm the credit references you've provided, it affects their ability to assess your creditworthiness. Temporary or irregular employment. Having a job that is not stable or predictable can impact your ability to make consistent payments. Unable to verify employment. If the lender cannot confirm your employment status, your income becomes uncertain. Length of employment. A short time with your current employer might raise concerns about job stability. Income insufficient for the amount of credit requested. If your income is too low compared to the loan amount you're seeking, it could make repayment difficult. On the other hand, several factors can increase your chances of loan approval. Here are some key considerations. Low debt-to-income ratio. If you have a small amount of debt, compared to your income, it shows you have the financial flexibility to handle more debt. Verifiable and stable income. Providing clear and verifiable income documentation, like pay stubs or tax returns, increases the lender's confidence in your repayment ability. Long-term residence. Having lived at your current address for an extended period demonstrates stability. Permanent residence. Owning your home or having a long-term lease suggests a stable financial lifestyle. Established and robust credit file. A comprehensive credit history with different types of credit and a positive payment record indicates a lower risk. Good credit performance with current lender. If you've borrowed from the same lender before and paid on time, it shows reliability. Positive credit history with other creditors. A history of making timely payments to other lenders reflects a good credit reputation. Complete and accurate application. Submitting a fully filled and accurate application speeds up the process and shows organization. No recent legal or financial setbacks. Avoiding issues like garnishments or bankruptcies demonstrates financial health. Sufficient and suitable collateral. Offering valuable collateral that can secure the loan reduces the lender's risk. Qualifying terms and conditions. Requesting loan terms that align with the lender's offerings makes approval more likely. Adequate down payment or trade-in. Providing a significant down payment or trade-in reduces the lender's exposure. Established credit references. Providing credible credit references from reputable institutions can support your credit worthiness. Verified employment with longevity. Having stable, long-term employment with verifiable income shows your capacity for consistent payments, sufficient income for loan amount. Requested, having enough income to comfortably manage the loan repayment signals low risk. By understanding these factors, considered by Loan Plus 3 and the lenders who use it, you can gain insight into the loan decisioning process. Remember that meeting these positive criteria generally portrays you as a responsible and lower risk borrower, which can positively influence the lender's decision to approve your loan. This concludes the credit evaluation and loan decisioning training. Thank you for watching. See you in the next lesson.